Good evening, good afternoon, good morning, depends when you watch this and where you're watching it from. Welcome to another live stream. I'm going to be giving my monthly update on the property sector and the economy as a whole. The highlight for today's broadcast is that the South African Reserve Bank, which is South Africa's central bank, has increased the rate at which they are lending to us, which is called the prime lending rate. They've increased it by 0.75 basis points. So really what we're trying to figure out today is how that's going to impact the property market. And as a property investor in the South African space, I'm quite well adept to speak to that. We also see a nice trend that women are dominating the property space here in South Africa. That's exciting. And we're also seeing a property recovery from our doom and gloom COVID days to where we are now. So that's going to be more or less the agenda for today's session. I'm going to be taking you through some statistics, some newsletters, some reports, and giving you my general feel as to where the economy and where the property market is going. So the main thing and probably the meat of this call is really to talk about inflation and how higher inflation leads to higher interest rates. And we've seen that inflation has been and continues to be a big concern for the South African Reserve Bank and for every central bank around the world. Guys, we're not isolated in the situation. The US is also having high levels of inflation, which is forcing their Reserve Bank, the Fed, to also increase interest rates. Europe is feeling the same kind of pressure, and their central bank is also going up with interest rates. So this is something that's happening globally. I think we've been in a very nice monetary policy environment. Since COVID started, there was a great decline in interest rates to stimulate the economy, and I think those days are gone. I think for now we should start expecting 9, 10, maybe even 11% prime interest rates going forward. So as of yesterday, I think the 23rd, no, as of Friday, the Reserve Bank increased the repo rate by 75 basis points, which then increases prime lending rate by 75 basis points. And this is due to high levels of inflation. So if you go onto the South African Reserve Bank website, you will see that the repo rate is 6.25%, making prime 9.75%. This interest rate increase has a massive knock-on effect. So yes, it increases, it's hopefully there to fight inflation, but what does it mean for us as the end consumer? Things get more expensive, right? So here I've just taken a quick example. If you were to have R1,000,000 in debt, at a 9% interest rate, which is what the interest rate was prior to Friday's announcement, over a 20-year period, your monthly bond repayment would be just shy of 9,000 Rand, 8,997 to be exact. Now factoring in that extra 75% interest rate that has been increased, your monthly bond is now 9,485. So per R1,000,000 debt that you own, you're going to be spending 488 Rand extra per month. That on top of an already escalating cost of living, you can start to see how this adds up. And also, if you only have one property, okay, 488 Rand per month is not a lot. But if you have a 10 million Rand portfolio, a 100 million Rand portfolio, a billion Rand portfolio, you can start to see how this has a big impact. That's the negative side of an increase in an interest rate. The positive side is that all of your savings account and everything linked to Prime also goes up. So, if you've got a Standard Bank, ABSA, or whatever bank you use, you've got a savings account, your account, your market link account, would also link to the market increase by 0.75 basis points. So, there's some bad, there's some good. Now, with the rise of cost of living, we're going to start seeing an increase or we've already seen an increase in lots of consumer goods. On the top right, you can see what the increase has been for eggs, poultry, milk, coffee, baked goods, dining out, and fruits and veg from May 21 to May 2022. So an increase in interest rates is just going to exacerbate this because now everything is getting more expensive. All of these providers and suppliers of these materials are also having an increase in their interest rates, which means they're going to try and push that cost onto the consumer. Another increase, I think you guys are seeing where I'm going with this. Everything's getting more expensive. There's lots of talks that we're heading into a recession. This was the notice I received in July that my COJ and my my different municipalities are going to start charging more, right? So, with increased interest rate, what's another knock-on effect? We've spoken about how your bond repayment is going to change. We've also spoken about how your savings accounts are going to change. We've also spoken about how this is going to lead to an increase in expenses for other people or for the general end consumer, being us. There's also been a knock-on effect on the stock market. Now, the stock market tends to enjoy low interest rates. There's a lot of growth that is stimulated, and that makes sense, right? When you have low interest rates, you have easy money or you have cheap money. So companies take out a lot of debt and expand and grow. And as you start to grow, you see inflation rise. And as you see inflation rise, the reserve banks and the central banks start to panic, and they have to curb that inflation by upping the interest rates. And as they up the interest rates, then debt starts to become more expensive. And companies start to pull back and say, you know what, I'm not going to take on that much debt. I'm going to rather start reducing. And that's how they see a curb in growth. So I took the snapshot this morning. I was listening to Bloomberg. I watch that show regularly to get a sense of what the stock market is doing. And here you can see three of the biggest index funds, the Dow Jones, the S&P 500, and the NASDAQ, all in the red today because their federal government or their central bank also increased interest rates. And this is the knock-on effect. So as you increase interest rates, you're going to see a drop in the stock market. Here are just some averages of what's been happening in these specific indexes over the last few years. The key thing to look at is this year's performance. So if we start on the top left, you can see the S&P 500 year to date is at a loss of 22.5%. So if you had 100 Rand invested in the S&P 500 in the beginning of this year, it's now worth 78 Rand. The Dow Jones is down 18.5% and the NASDAQ is down 30.5%. And that's, estimates for the NASDAQ are to get worse. So it says here that NASDAQ faces another big plunge of 10% or more. So, I don't think the bleeding has stopped. Is there a recession ahead? I don't know. I don't think I'm educated enough to answer that confidently, and I don't have all the data. But there definitely seems to be some sentiment that we're heading towards a recession. You've got a crazy increase in prices. You've got this war in Ukraine and Russia, which has upped the petrol price, which increases the price of everything because everything uses petrol. And food has gone up because Ukraine is one of the biggest grain providers. So it's just, I think there's a bit of a perfect storm of tough economic times coming ahead. So this live stream isn't doom and gloom and trying to scare you off the property track. In fact, I hope that this inspires you to get into the property game because you need something. You need to start getting backup plans. You need to start having multiple streams of income. I've been talking about this for almost a decade now, and I probably sound like a broken record player to some of my friends and family, but it's true. Relying just on a job where you're getting a 5, 6, 7% increase year on year is just not going to be good enough because inflation's 6, 7, 8%. So your increase is effectively less than what inflation is, meaning you're technically getting poorer by staying in your job. And having multiple streams of income gives you a little bit of flexibility. Another hopefully positive thing that I can share about recessions is that more millionaires and more money is made during a recession than any other time in history because prices of things are cheap, which means you can buy these companies or you can buy properties at discounts, end up making more equity in the gain. Also, here's a nice visual to show you that although recessions are painful, expansions are more powerful. And after a recession, there tends to be an expansion. So you can see the top half of the graph is showing you the expansion since 1950. And the bottom of the graph, the red zone, is showing you the recessions. So obviously here, something a little bit more relevant in the time that we're in. Here you can see in 2008 and 9, that's when we had the property bubble that burst. And you can see that there was a massive decline in the GDP and the gross domestic product of the world. And then straight after that, we've now had a huge amount of growth. We've had several years of growth, and we're likely heading potentially into a recession. Recession on a technical level means that you have 2 quarters of negative growth. So that's the technical definition. Also, something to note is that your average expansion period, the time when there is good growth in the economy, is 67 months versus your average recession period is 11 months. So, guys, if we are heading into a recession, you know, you can take a little bit of solace in the fact that it's probably only going to last a year. And after that is going to go into an expansion stage. And during a recession, prices are cheap. Discounts are to be had. If you've saved your money, you've got a bit of cash, you've been good and financially wise during the good times, now is the time to buy. Now is the time to get invested. Now, property. Property is a debt business. And one of the most common questions I'm getting now is people are saying, now with increases in interest rates, what do I do as a property owner? I've got all this debt, and now the interest rate is just going up and up and up. What must I do? I mean, I've got several property groups, and Bongani asked me here, like, should we wait and observe? I'm starting to get scared. What if the interest rate doesn't stop? It's a good question. I've been telling my students, and I've been sharing that I believe the interest rates that we've seen during COVID were temporary at best of times. Before COVID, we were at 10.25 prime lending rate, and we're heading back there. We're probably going to see a stabilization of the interest rates in November, December this year. That's what a lot of the banks have been talking about. So I think there's another 0.25, 0.5 that's going to get us back to that 10.25. That historically has been our most common range for an interest rate. So, for the last couple of years, when I've been doing my analysis, it's been at 10.5. I've always been using 10.5 as my default interest rates because if the deal makes sense at 10.5, then I know I've got that buffer. So when the interest rate was 7%, I was still using 10.5 because now that we're getting back to 10.5, my deal still stacks. It's still good. So even though debt has become more and more expensive, it's been baked into my numbers. And that's probably the best and biggest advice I can give to those of you starting out. Use a conservative or at least stress test your deal. Do different scenarios. Say at 3% interest, at 10% interest, at 15% interest, where does my deal still stack? Because then at least you know how far you can go before you get into trouble. For those of you who are already invested and you bought at the height of COVID when interest rates were super low, and now you're sitting with a negative cash flow asset because there's just the debt's gotten too expensive. What I could say is your best bet is probably to erase some of that debt. High interest rates, it's a good time to down your debt, to pay down your debt. So maybe you've got some savings, maybe you've got some stocks that you can sell, maybe your salary can cover a little bit of your debt. I did that at July of this year when we had another increase in interest. I took a little bit of my savings and I started paying down some of my debt because debt was starting to get expensive again. So let me talk about a concept here. Let's say that you buy a property and you've obviously got some debt on that property. Now in 2020, we had interest rates of 7%. When you've got good, or let's say easy economic policy, i.e. you've got cheap interest rates, it's a good idea to take a lot of debt. Because the money is cheap, it allows you to scale. It makes a lot of sense to take money and to buy income generating assets, not to go and travel or buy that car that you want to impress the people that you don't even like. No, it's about buying income generating assets. Okay. Then when times get tough and economic policy is not easy, it's actually difficult, like in 2022 where we're sitting now, we're edging closer to 10%. It makes more sense to take your money, your additional savings or cash, whatever you may have available, and to start to reduce your debt. Now, when you take money, let's say you've got your salary and you've got an extra 10,000 Rand and you're going to put that 10,000 Rand into your bond. That 10,000 Rand is now effectively working for you at 10%. Because if you're not being charged the 10% interest, you're effectively gaining the 10% interest. So during high interest rate areas, it's nice to put your money into the bond or into your bond repayment because you start to effectively get a good return on your money. Make sure it's an access bond. That's the important thing. As long as you can put money into this bond and then release it at a later stage, it's good to pay down your debt during when the interest rates are high. Okay. Now, I always recommend that you don't go higher than an 80% loan to value. I hope that you haven't over leveraged. I hope that you don't have 105 or 110% loan to value, because you know the debt repayments are going to probably kill you, and you're going to probably be not liquid enough to actually sell your asset and cover your debt, which might leave you in a tough financial situation. But the advice that I would give to those of you who have bought and now sitting in a situation where you've got a negative cash flow asset, pay down some of your debt. I think that's probably, other than selling the property, and hopefully you don't have to sell at a loss, your next best bet would be to take your additional income and put it into your access facility. Okay, so that's just a bit of a general introduction to this whole inflation story. Let's look at South Africa a little bit more. Let's highlight what are the concerns that are surrounding South Africa. Now, there are 4 key points. I got this from a Business Tech article that was released, I think it was early last week. And they spoke about some of the main points that we have to be aware of as South Africans. The first one is one that we're all aware of. Okay. Right now, I'm sitting without power. Luckily, I've got a UPS for my Wi-Fi, and I've got a laptop that's charged. But this is not new. Right? We've been dealing with power cuts since I think it's 2008. This year has been the worst in terms of total electricity or total time of load shedding that we've had. This year has been the worst. And guys, it's not going to get better. I mean, I don't exactly see Eskom coming up with a massive plan to change this. So what does this now mean for our economy? I don't think it's good. I think there's definitely going to be a hesitation from international investors to get involved. We've seen the rand kind of plummet against the US dollar and the pound because of our lack of electricity. Without power security, that's a huge risk. So that's something we have to be aware of. This isn't going away anytime soon, and it's going to continue to erode our economy. From a market perspective, and this is directly off the back of these power cuts, is that the rand fell 2% on Friday last week against the dollar. And that's because the dollar is doing well, but it's also because South Africa as an economy is struggling, because when you don't have secure power, you know, your businesses start to fail, your houses start to erode. It's really not good. The third thing is that we obviously have politics at play. Now, I don't want to get into politics, and I don't want this channel to be about people's opinions on politics. But something we do have to be aware of is that the politics does have an impact. It's a macroeconomic factor that impacts the property market. So we obviously know that Dlamini Zuma is heading up the rate faction, and she wants to basically get rid of the step aside rule. Which I think personally is a bit crazy, but this is something that's going to be playing. We've got our elections coming up. We've got ANC that have got its own inter-party kind of frustrations and fights. That's gonna definitely set South Africa either on a good path or it's going to worsen it. And then finally, maybe a bit of good news is that we do have a rating agency that rated us as investment grade. The 3 major international ratings still put us in a junk status, which is a bit unfortunate. So those are some of the main things, right? We've got these massive power cuts. We've got a declining currency. We've got political instability or uncertainty. And then we've got a low credit rating. So, you know, off the back of that, I would say South Africa is still a very good place to invest, and I still have, you know, majority of my wealth in the low income market in property in South Africa, and there's no way I'm changing that. But I think it's also wise as South Africans to offshore some of your capital in the event that things go very south very quickly. So having some money in US stocks or in pounds or in whatever currency you want, just having, even if it's just a small portion, 10 or 20% of your wealth to be outside of South Africa, I think is a really good practice because the risk is high here, but the returns are also high. So, you know, take that as it is. 2 other indicators that I'm looking at when I'm looking at South Africa as a whole is firstly the consumer price index, which is your CPI, your inflation rate. So here you can see that, the Reserve Bank wants to be within that 4 to 6% category. We're kind of in that realm now, so that's why I think that interest rates are going to stabilize in the short term and hopefully for the long term. On the right hand side is probably one of the biggest risks that I see in our economy, and that is the number of our debt in relation to our GDP. So we're currently, sitting at 65% of our entire GDP goes towards debt, um, which is quite scary. And I think a lot of countries are in this dilemma. But that's definitely, if it's not curbed, is a massive risk to the stability of our economy. From a property perspective, some of the key highlighting facts that I'd like to mention in this month of September is, first of all, women are leading. There's a recovery from COVID. There is a lot of foreign interest in our property sector, and we're seeing some steady inflation. So first of all, women in South Africa are killing it. So women own or co-own more than half of South Africa's homes and are buying a third of the cars being sold. I think this is, in my opinion, probably the best statistic or news article that I have to share with you guys, because I think women have historically been disadvantaged and held back. And I just feel like right now we're starting to see a massive change in our gender relations, and it's great to see that women are now buying more and more properties and equaling men in terms of purchasing power. There has been a revival of the property market, and this was from Lightstone's July edition. South Africa's property market is showing signs of sustainable recovery following a drop in sales caused by COVID-19. And I've got a couple of cool little graphics for you. So here you can see the total volume of transfers year on year, or quarter on quarter for the years 2019 up until 2022. So if we just look at Q1's sales, for instance, you can see that there is a steady growth from 2019, 2022, 2021, and 2022. You can see that there is a steady amount of sales in Q1. In Q2, you can see that in 2020 we had a massive dip in property volume and transfers, and that's just because that was the time when COVID became a thing and nobody wanted to go and do viewings and people were so uncertain. So we've seen a nice recovery, and essentially we're seeing the types of volumes that we saw pre-COVID and substantially more. So there is a nice recovery in terms of the amount of sales that are happening. Another stat to look at is the volume per price band. So there you saw the general sales in general. Here we're seeing by price band. Now, I know that the colors here are not great and not very easy to see, but right at the bottom, the lowest line you can see is your 3 million plus property transfers, which has gone up slightly. Then the next one is your under 500, which is your lower LSM. So there was a bit of a dip, and it has recovered. Then we've got our 500 to 1 million, also has a spike up leading into 2021. And then we finally got our 1 million to 3 million, which is the highest performer and having the best amount of growth. So it's clear to see that 2020 was a bit of a dip, but there has been a sustainable growth upwards. In terms of foreign investors, this I found very interesting, but there has been a substantial growth in interest of foreigners owning property in South Africa. So at the bottom you can see the legend which shows the different provinces. Our top performing provinces, which is not surprising, is Gauteng and Western Cape. That is where the majority of foreign interest has been. You can see stats from 2014 all the way through to 2021. At 2022, in the month of COVID, we saw a bit of a decline, but in 2021 you can see a substantial growth. Almost 15% of all property transactions in the South African economy was to foreign investors. That's a good sign. That's a really good sign for me. I think as much as we've got the junk status as a country, I think we're still investment grade. I still have my money here and I still intend to invest my money here. And I think that there are some savvy investors and savvy foreign investors that are looking at this economy and saying, hey, you can get yields of 15, 20, 25%. You can't get that kind of yield in Europe. You can't get that kind of yield in the US. And yes, their lending rates are much different. So they don't necessarily need a 20% yield to make a profit. But it's very hard to find that kind of yield. And that's why a lot of the conversations I have with people who reach out to me via my YouTube channel or want to partner with me or whatever are often people living outside South Africa, because they look at my videos and they're like, geez, man, you're getting 15, 20, 25, 30% yield. So the money is to be made. It doesn't come without its uncertainty. It doesn't come without its risk, but there's definitely money to be made. In terms of some of the property inflation stats, here you can see that the most recent statistics show that Northern Cape is a winner. 9.64% is the average rate of capital appreciation in that province. We've got some nice growth in Mpumalanga and Eastern Cape. Western Cape has definitely recovered. When I last did a video on this, I think it was about 6 months ago, the average rate in Western Cape was 4%. And now it's hovering at over 6%. The biggest loser is Gauteng and Mpumalanga, and not Mpumalanga, Limpopo. So unfortunately, Gauteng's only at a 3.7% cap rate, Limpopo at 2.72, which is not great. But the cash flow in Gauteng's really good. So, you got to weigh up your options. My final bit of update as to how things are going in property is to show you the inflation rate per price band. So you've got your low income all the way through to your luxury. The legend is here on the left. So luxury is anything above 1.5 million. High value is 700 to 1.5. Mid is 250 to 700, and low is under 250. So what we're seeing is that the inflation, right, the value or the appreciation of the property is highest in the low income market, which is quite interesting. So it's sitting at around 10% is the growth in the low income band. And then you've got your luxury in red, your mid value in green, and then your high value in dark blue, which are all hovering at about 4.5-5%. So that's more or less the trend that I've been seeing the last couple of months. That 4-5% is pretty much a sustainable growth rate for most properties in South Africa. Obviously, depends on the area, the supply and demand metrics in that specific area as well. But yeah, I mean, all in all, I hope that the news wasn't doom and gloom. I do think we're heading to a recession. And I think that has a massive impact on the end consumer. And I think a lot of people are not prepared. I think a lot of households are going to struggle. I think we're going to see some potential social unrest. I think we're going to see some potential political instability and political fighting. But this is also South Africa, and this is why we love it, right? I don't think that investing in this area comes without its risks. So with all the risks and with all the bad news, is this still an area I would invest? 100%. Is there still long-term growth? 100%. Is there good deals to be had? 100%. Is there a better time to invest in property? No. Well, actually, yes. 20 years ago was a better time to invest in property. The next best time is now. So yeah, I mean, I have no intention of slowing down. I hope that you don't either. I hope that you take all of these obstacles with a grain of salt, and that you don't give up and that you persist. And then finally, I hope that you subscribe to my channel if you aren't already subscribed. I've got a whole bunch of new content coming out. So all the content that you've seen there, it's all old. And I've been recording content for the last 9 months. Really awesome new content. I've also upgraded my equipment. So all the content that you're seeing now is stuff I recorded over a year ago. All the new stuff is going to be coming in 2023. So please do subscribe, join the tribe. If you like my vibe, then hit a comment, hit a like, share this with friends and family. And until next time, happy investing.